thank you all for making it after the very long couple of days. We're in the final stretch here on a topic that I find super exciting, very interesting, an industry that I, as many of you may know, am super passionate about. As you may have learned as part of my style, I always like to start by getting to know my audience a little bit. So I'd love to see, by show of hands, again, who in the room either has mined Bitcoin or has invested in a Bitcoin mining company? Oh, wow. Okay. So we've got a pretty sophisticated audience here. Very impressive. So we have true alternative investors. Okay, so that really helps because that allows us to focus our discussion on people who already really understand the asset class. So as we all know, there are many ways to think about how we approach Bitcoin as an alternative investment and an alternative to investing in Bitcoin directly, which is one of which is through mining. Now, investing in mining is once you kind of have that orange pill and you dig a little deeper down that rabbit's hole, you see that it's not quite as simple as deciding whether or not you want to buy a miner or not. There are a few ways to invest. You can buy. There are, I think, 29 publicly listed miners now that we track. Mm-hmm. I don't know how many there will be a year from now, but my guess is not more. There are opportunities to invest through private markets, private equity, private debt. There are options for you to go out and buy machines. People used to mine in their garage. The days of garage mining are probably over if you're paying your own electricity bill. But if someone else is paying it, then more power to you. So just maybe start with with our esteemed panel here. I'd love to hear, Amanda, your views for an institutional audience or for a sophisticated investor looking to approach this asset class. What are some of the key considerations when they decide whether they're going to invest in public equity, private equity, debt, and the minor business models that they might be looking at?
Sure. So I think that the really interesting thing about Bitcoin and Bitcoin mining is that everyone kind of got to know Bitcoin, and then you dig a step deeper and you're like, this is mining. And we kind of bucket miners into one category. And that's very unfair because miners' operations and what their long-term strategic plan is really important. So operations and due diligence is one of the things that we focus on when we're thinking about debt and also equity investments. And so understanding that side of the business is super important in order to say okay, is this a good company in order that I should be investing in? What is their growth strategy? What is their ASIC procurement strategy? What are they hedging treasury management, right? What is their treasury management strategy? So I think that there's a lot of different angles that a miner can take, and it's really up to the investor to take a second, really understand what the miner is doing, and then do the due diligence in order to really get the structure to then invest. Because not all miners are created equal.
Not all miners are created equal. That's certainly exactly what I was thinking as you were saying that. And so Ben, I'd love to hear. Now not all miners are created equal. Looking at the public miner universe, there's pretty significant dispersion and really actually not much consensus on how to value these businesses. What are some of the key metrics that you think, as an investor is considering, which miners to buy in their portfolio, which miners to potentially hold short in their portfolio, if you would recommend that? What are some of the key metrics that investors are focusing on? What are some of the key metrics that you think investors or analysts that cover the industry are focusing too much on and actually aren't as important?
Yeah, it's a good question. I think this is a very new industry. When we started 2021, there was just a handful of public miners. And when Bitcoin started taking off, the demand for exposure to Bitcoin and other proxies through public markets was really, really high. the market not really understanding, I think really latched on to this end of 2022 hash rate number. This is something that is easy to grasp. It's something that almost every public company had announced, and something that you could do kind of an apples to apples comparison of. If this company says they're going to be at 8 exahash, this company says they're going to be at 10 exahash and 3 exahash, I have a relative idea of the size. But I think that really is emphasized too much, because what that does is it doesn't properly value current operations. And there's a big difference between what you're going to be able to possibly do in the future versus what you're actually doing now. And the reality is that Bitcoin mining is a cash flow. Every single miner itself is generating a cash flow in Bitcoins. We don't actually know, and nobody can tell you what the value of that Bitcoin cash flow is going to be worth in the future, but I know what it's worth today. I know what it's generating today, and I can predict how many Bitcoins I'm going to mine over the next 1 day, 1 month, 1 year, with some basic assumptions around network growth and participation in my own costs. But if you're only focusing on future hash rate, you're completely ignoring the huge money printing that we're doing today. And I mean, these miners are money printers. You have, even at $30,000 Bitcoin price, an S19 is making $17, $18 a day right now with virtually no manual input. What other industry in the world is printing cash like that? There's zero. And so if you're focusing on the value of that expected cash flow in the future with so much underlying volatility in the Bitcoin price and not taking into consideration performance today, I think that's a real disservice to your own portfolio. So, from my perspective, I think you should be looking at, hey, what's your current performance in terms of hash rate? I think you should be looking at, is that hash rate that those companies are disclosing, is it generating the amount of Bitcoin that you expect it to be generating? Because that's a number that you can predict, and it's a number you can verify. So just with those two numbers alone, you can already start tracking which companies are good operators and which companies are not such good operators. I think that's where I would focus. And then you have to start looking at, if this is a cash flow, what does it cost me to acquire this cash flow, right? The value of that cash flow, not necessarily certain, but what it costs me to acquire that cash flow today is, right? And so I need to be making my calculations on my return on investment, not only on what the expected future value might be, but what the cost of that cash flow is today. And I think that's a thing that's been drastically overlooked by the market. People latch on to 100,000, or 200,000 or 300,000. It doesn't matter what that number is if you're paying too much for it, right? Growth is not net. You don't want growth at any cost, right? You want the appropriate growth at the right cost, and you want to manage those cash flows. So I think that's something that the market really needs to understand, is that an S9, which is a 6-year-old piece of equipment, is going to cost you a few $100s. An S19 is going to cost you a few $1,000s. And even though the S9 is cheap and not super profitable, because of that cost, it actually has a very good ROI, right? And so there's different applications here, and you need to be looking at the cost of your cash flow and what you expect that cash flow is going to do over time, and generate ROI calculations out of that. As at the end of the day, I'm a profit maximalist. And if you are not a profit maximalist, you should not be in this business. And you won't be for very long. You will be outcompeted.
So looking at, many investors in this room may be considering choosing different miners that are listed, evaluating opportunities that are available in the private markets. But as we know, some consider that they just like to mine for themselves. That they'd like to, and garage mining, as it were, is no longer an opportunity. So what are some of the key considerations? Now, again, considering this is more of an institutional audience, where garage mining was probably never on the radar, what are some of the options for those who want to get into mining themselves? And how do they deploy those investments in infrastructure if they want to focus on machines? Ro, I'd love to hear some of your views on how those who want to invest in their own kind of prop mining operations can approach that asset class, and some of the key considerations that factor into that.
Yeah, that's a great segue, and to piggyback off of Ben's comments, Bitcoin essentially is a commodity, and mining Bitcoin is cultivating that asset. A common metric that both publicly traded miners or large-scale miners use is the cost per Bitcoin generated. So what is your actual CapEx and OpEx that you're investing in to achieve that one per Bitcoin? In many cases, for over the course of the last 18 months or so, the metrics were around on the low end, sub $5,000 per Bitcoin generated. And average, I think today we're seeing $12,000 to $15,000 per Bitcoin generated in terms of a cost of acquiring that Bitcoin. You take that figure compared to market prices at nearly 30,000. Right there is a comp that it's very easy for people to understand, no matter which part of finance that you're in. It's a great way to get a good comp from miner to miner.
Can I piggyback there for a second?
Yeah, of course.
I want to be very specific when we say cost to mine, because I think one thing that we noticed, we track a lot of the public miners, everyone calculates that differently, right? So like there's the marginal cost of production, and then there's the all-in cost of production. And the all-in cost of production is where that operational piece becomes really important. So you have to have that like really good setup that is up and running a large majority of the time in order to have that full all-in cost to mine lower than the Bitcoin price. So again, like the operational component of a Bitcoin miner from miner to miner is really what separates the good from the bad.
So we've all seen quite a number of deals in the private markets. Whether it's emerging, scaling, startup miners. I'd love to hear, having seen some very interesting, colorful presentations, promises, what are some of the things that you think investors should watch out for as red flags as they see these private opportunities being presented to them?
Yeah, I think it's a good question. There's a lot of companies that are coming out there. There's a lot of interest, and there's a lot of ability to raise capital, especially when the level of understanding is very low and the potential is very high. But this is a commodity. Everything's commoditized now. If a company is coming to you and saying they have an elite edge, that is already a red flag for me.
Without any operational experience.
Yes. I mean, if you've done nothing before, zero experience, and you have the edge, I'm sorry, I don't believe it for a second. If you say that you're going to scale infinitely, sorry, I don't believe it for a second. And in this world, I've seen a lot of different deals. The modeling is incredibly simplistic. And it would shock, I think, most of the people in this room, the models that most mining projects are based on. They are not based on any real-world mathematics. They take assumptions that are not possible, things like a constant difficulty rate. So, if you have a growing hash rate, you have a growing difficulty rate. If I'm growing my own operations, I am increasing the difficulty rate for everybody. But I've seen numerous models that predict constant economics, or even flat difficulty and rising Bitcoin price as they grow their own hash rate. These are just not possible. So people who are predicting things that are too good to be true are most likely too good to be true. This is a business where experience really matters. And deploying one miner, anybody can do it in 10 minutes. You watch a YouTube video, you buy a miner from Compass, and you plug it in, and you could be up and running. But to deploy tens of thousands of these machines and keep them operational and keep them economical in bear markets, that's a whole nother thing altogether. And best of luck if you're two guys in a garage.
I would add that on the modeling side, one thing that we get a lot from institutional investors that are looking at Bitcoin miners is, what's the lowest price that Bitcoin goes to before I have to be worried about my investment? And it's not a static thing, right? Because Bitcoin and hash rate are one and the same. So as Bitcoin moves, your hash rate moves. And so you have to look at both of those inputs at very deep levels to understand, if someone's saying Bitcoin price is going to moon and hash rate is going to go down, probably not going to be a profitable operation, because that's not a realistic scenario in the world. I also, I think that other red flags to think about is, I'm going back to this conversation that I had with this guy who wore a suit and said, I'm a miner, I have 4 GPUs in my basement, my business partner is my wife, and I need $100 million. So probably not, we need like robust, experience and models, and I love the like, everyone wants to be a miner, and I think that the business for that is really what Row does, right, with Compass. Like, they're offering a service that is incredible for people that want to get into mining at a smaller scale. But if you want to get into mining on a bigger scale, I would suggest partnering with someone that has done it before, right? There's lots of groups that are out there trying to scale. You need a lot of capital in order to do this, both on the OpEx side and the CapEx side. So find someone that has done it before that's willing to work with you, and that's like a great way to continue to scale and grow.
So believe it or not, sharing things like stable difficulty assumptions. We looked at a presentation from a miner that we passed on for our clients last year that had a stable difficulty assumption. That was one of the key reasons. Just the fact that they put it in there allowed us to sign very. That's one of the things that we know is wrong. So what else that we don't know is wrong is in that presentation. That miner subsequently raised $700 million from a large private equity fund, from a fund of hedge funds, from a tier 1 crypto exchange, from an ultra huge a handful of family offices, but a very large syndicate, and on the back of clearly a lot of overpromising. That organization is now facing serious challenges. Some of you in the room probably can guess based on that who I'm alluding to. But anyway, what is your concern? Something that for those of you who've been part of, we're just joking how many panels we've been on together in the last few months. But something that I've certainly consistently been saying is that I was concerned about a lot of overpromising by certain organizations casting a cloud on the entire industry and sector. Absent a correction in Bitcoin price and how that could bring down valuations, as investors have a difficulty discriminating between those organizations that have been making credible promises and those that haven't. I'd love to hear your thoughts on whether that's been the case, whether you've seen a lot of overpromising in the market, whether you think that has unfairly cast a cloud on the entire industry, and that's part of the fact driving recent valuation and pricing, or whether that's more market sentiment. Maybe Ro, I could ask you to start on that one.
Certainly. In any early stage company, investors are really investing in a management team, and that management team's expertise in starting and cultivating businesses over a period of time. What's missing in a lot of those early stage companies is, again, that experience from an operational perspective in mining operations. And I think that's one key item that seems to be missing. For Bitcoin mining specifically, it's a relatively low barrier of entry. You really need 3 things. You need access to capital, access to ASICs, and access to infrastructure. And if you have access to those 3 things, you can start Bitcoin mining. A lot of people are really good at raising capital, but may not have the operational expertise to operate that entire portfolio. In another case, some may also be over-leveraged, being financing at very high rates to acquire hash rate. So just some of those red flags to keep an eye on.
If you look at the price of Bitcoin and the market cap of public miners, it trends pretty closely to like if Bitcoin goes up, miners, market share goes up. If Bitcoin goes down, market share goes down. We really need to get away from that, and that just means that like education and like analysts understanding how to value one miner to the next is going to become increasingly important as there's more saturation in the market.
I think one thing that people don't understand, and this is not necessarily true for every Bitcoin mine, there's obviously all sorts of different models for how people structure their energy purchasing and their OpEx, but for a company like Bitfarms that's running their own vertically owned operations, we have a very fixed and stable cost to run our equipment. It does not change. I have stable energy prices. I have stable rents, stable labor, stable tax. Like, I know exactly what it costs me to run a machine. And so this means my costs are very, very fixed in terms of that operating. What I need to do is I need to plan for the worst, right? I want to plan my operations for the worst possible scenario so that even when markets pull back, I'm ready for it, and I'm so competitive on cost that the other people have to cede me that market share. And this is a key thing. I think, part of this overpromising is this idea like, hey, there's a lot of FOMO. People want to overpromise because they're focused on these really big numbers, and they want to buy into these really big numbers. And it's almost counterintuitive, but you want to invest in mining operations that are structured around planning for the worst, right? We know that even when Bitcoin price pulls back, our costs are stable. For the last 5 quarters, we've had a cost to produce a Bitcoin that's varied within $2,000 as the price of Bitcoin's varied 30,000, there's a huge difference there. And for us, as long as we've planned our facilities, our economics, and our miners around a really competitive cost to produce that Bitcoin, then it's all upside from here, right? So even if Bitcoin's at 30K, I'm producing my Bitcoin under 10 grand, I have a 66% margin. Bitcoin goes to 66, my margin goes up. It's just extra upside, right? But even at 30K, I'm profitable, right? And there's a lot of people who are not planning their operations that way. And I think that's a big limitation. You need to be planning for the worst. And when the best comes, it's all upside. But when the worst happens, you survive, and you're well positioned and well capitalized to move forward, take advantage of these pullbacks, make strategic opportunities for growth when the price is the lowest. And those are the companies that will do the best over time repeatedly.
The best time to invest in a Bitcoin miner is in a bear market, because you separate out who is really good at what they do and who kind of got in probably too high, paid too much for electricity, paid too much for hosting, paid too much for infrastructure or ASIC costs. And you can really, in a bear market, kind of decipher who's good and who's bad. I think one thing that we're watching, so at Galaxy, we do our own prop mining. We don't really share our operations that much. I'm still a little quiet about that. We also provide miner finance to miners. And then we also do strategic investments. One thing that I'm looking at is I think there's going to be an influx of distressed debt over the next 6 months for miners that got in at the top that probably won't be able to operate over the next year. So that's like one area to consider, to look into as you're thinking about investments. And then also I think there's going to be a ton of M&A. I think M&A is inevitable, just because people got in and they won't be able to sustain when they got in at.
Yeah, absolutely. We're really looking forward to seeing some M&A deals as an investment banker. Again, on one side, you have those, thoughtful, patient miners who didn't FOMO, didn't go crazy buying machines. Some of them saw the opportunity in capital markets and hit the ATMs and hit the pipes and did deals, but sat on that capital. And then there are others on the other side who did the exact opposite, that basically just took on a ton of liabilities, liabilities to make payments to Bitmain, liabilities to make payments to lenders, with liabilities to buy power at sometimes high prices. So we agree that we're going to be seeing an interesting market for M&A consolidation. Again, I alluded to at the beginning of the presentation. I think there's about 29 public miners, but I'd be more surprised if we don't see fewer of them in 1 to 2 years from now than more. There's certainly a lot of deals that people are still trying to push through the public markets. It's going to be very difficult in this time to get valued at a premium to NAV as a newly IPO'd or SPAC'd miner. And probably the best opportunity is in those that are ready to take advantage of this downturn.
Correct. 2022 is definitely the year of consolidation in our space. It'll be very interesting to see the best of the breed acquiring hash rate from other organizations that have built and grown over the course of the last year and a half.
So one of the things that we talked about in our prep call was the importance of not looking at miners, the quality of a miner's operations, the quality of their earnings, which suppliers they're using, where they're geographically located, I'd love to hear some of your views on that. And actually, I'd love to hear about the idea of there's kind of one, it is a non-zero risk in pretty much any jurisdiction that you're going to have some isolated jurisdictional issue. What's the importance of diversifying your operations geographically, not being fully beholden to one power company or one government, one regulatory authority that can put you out of business? Ben, maybe you could share your views on that.
Yeah, I mean, that's
someone who's diversified internationally.
That's a super important strategy. I mean, it's part of Bitcoin's ethos is that you want decentralization. And the value of this cash flow is so great that if you centralize it in one location, you're really giving regulators, politicians, everybody a lot more leverage to use against you. That's not something that we want to do. We're believers in Bitcoin. We're believers in decentralization. And there's a huge advantage to spreading your operations. So, I mean, we have 9 facilities. Our facilities are on the smaller side of the scale compared to a lot of the larger facilities you see out there. But that doesn't mean that, we're not producing huge amounts of Bitcoin out of them. What we're doing is we're fulfilling Bitcoin's ethos of decentralization. We're operating 9 facilities in 3 countries, a 4th country under development. This means that if one incident happened, regulatory, legal, political, environmental, whatever, the rest of our cash flows are okay, right? And this is a way that we can diversify our mining operations internally to reduce our own risk. If we had everything in a single facility, you do get great economies of scale of having that, but you also have huge amounts of risk. And I think there are 2 things that people really need to understand when they're looking at Bitcoin mining investments. The first is that there's the profitability of the Bitcoin mining itself, and there's a risk associated with that volatility. And then there's the actual operational and counterparty risk. And, that compounds the underlying risk. This is a reason why this is a very, very profitable business if you can manage those risks properly. And I think decentralization is a key strategy. I think all of our companies are operating in multiple facilities, multiple states, multiple jurisdictions and countries, and gives us leverage.
Love to open it up to the audience if anyone has questions. Fred?
What do you guys think about talking about concentration with Texas? When does ERCOT put down boom? Because there's arguably 8 gigabytes of Bitcoin mining this year, most probably going live in Texas. I don't know, Ro, you were Ben.
And north of 10 gigawatts.
Yeah, north of 10 gigawatts. When does Texas just say enough's enough?
So Texas has, ERCOT created a task force recently where they said, hey, we've gotten a ton of input from miners that say, I want crazy amounts of energy. So let's take a step back and kind of evaluate that. And so I think Texas's approach is smart. Will it, hash rate growth might be a little bit more delayed than we expected from models of the beginning of the year. But I think that they're taking the right approach because they're trying to scale and also be open for business to miners. Oppositely, you have New York, right, which is trying to say, you know what, if you don't use 100% renewable energy, which, by the way, the New York grid is not 100% renewable. If you don't use 100% renewable energy, we might just say you can't, work in the state of New York if you're a Bitcoin miner, right? We're not open to business. So I think that there's, as things are growing and hash rate is growing and these companies are growing, going to a state that is a little bit more friendly to miners is definitely good. But I actually applaud Texas's approach to it because they're taking the smart route, right? Whereas New York, and we've seen Quebec before, right? Have the really nope, not Bitcoin mining. That's very bad for the environment, which we know that you don't agree with.
The Texas thing is interesting because it's the scale of it and the speed of it has just been overwhelming. We are one of the few public companies that have not announced any plans in Texas. It doesn't mean we haven't looked at opportunities in Texas, but there's so much happening there so fast. And it's hard to understand what the impacts are going to be when something this transformational happens this quickly. This is the freest electricity market in North America, one of the freest, if not the freest in the entire world. And the reality is that it's going to be the fastest to reflect price changes onto the consumer base. You know, from my perspective, I actually like being in places like Quebec that are highly bureaucratic, because that means that over time, they have actually a lot of impediments to increasing the price. They're a public service provider, a public utility. And over time, you know, they're there to provide a service. And if they increase the price on us, they increase the price on everybody. It's not something that they're, you know, very able to do. It's not something that's very politically, you know, a political win for most groups. In Texas, you know, if nat gas goes up, guess who's going to pay? You know, everybody's just consuming power there and who didn't hedge their prices accordingly. You know, this is what's going to happen is there will be really fast changes to the economics in Texas just because it's the freest market and the easiest to pass changes along to. And one of the things I want is stable, predictable pricing for the lifespan of my equipment, which is 5 to 7 years. It's not 18 months. It's not 2 years. This equipment will run 5 to 7 years. That S9 I mentioned earlier is a 5-year-old machine. Still profitable. Even at today, 30,000 Bitcoin, 4-cent power, an S9 does roughly $18,000, $19,000 a cost to mine a Bitcoin. That's still incredibly profitable. You know, it's 33% margin. How many businesses have that?
There's a unique fingerprint that the S9 has that Coinmetrics has come out with and figured out how to really figure out which hash rate is coming from S9s. And as of January, still 28% of the hash rate came from S9s. It's a massive amount.
Yep. But also in Texas, they're developing 70 gigawatts of renewable energy over the course of the next, I think that was the plan for the next 7 or 8 years. But with all the mining operations going into Texas, that certainly accelerated a lot of that momentum. So it certainly helps to you know, feed the narrative of Bitcoin mining being a catalyst for additional renewable energy development. Now, one could argue, you know, 10 gigawatts of infrastructure in Texas, what impact that has on the grid, and how much stress that'll put on the grid, and that's certainly why ERCOT, you know, took that extra step to evaluate, you know, additional developments, which is a responsible move on their part.
Well, I'd love to continue this discussion all day, but we are out of time. Again, thank you everyone for joining this panel, and love to have a round of applause for our esteemed panelists.